Hello, everyone, and welcome to another Wealth Management Fast Chat. I'm David Armstrong, the editor of wealthmanagement.com. I'm here on the line with Nick Milliken, the head of investment strategy for CAIS. Nick, thanks very much for joining us.
David, thanks for having us.
So CAIS believes that advisors are kind of stuck between this low real return environment coupled with a diminishing diversification benefits from a bonds and a rising rate environment. And there's an opportunity for advisors here to sort of reimagine the traditional 60-40 portfolio. Can you explain us a little bit how that works?
Yeah, I mean, the 60-40 portfolio has really provided investors with an attractive risk-adjusted return for the better part of a decade. Contributing to the return has really been that 12-plus year bull market in equities. Plus, we're more than 40 years into a bull market for bonds, which started back in 1981. The problem with this is really that the performance of the 60-40 assumes that these favorable conditions are going to persist and produce the same types of returns going forward. But given that outlook that you mentioned briefly there at the start for both equities and bonds, with equities appearing to be fully valued relative to their own historical levels and bond yields expected to head higher, that assumption seems out of line with broader market expectations. And additionally, we've seen banks and asset managers lower their capital market assumptions relative to the recent past. So this translates into an investment environment that is likely to be different in the coming years, meaning this is a good time to reassess that 60-40 portfolio and look into the use of alternatives whose performance is not typically dependent on the direction of the markets. Essentially, alternatives provide an opportunity to look at a wider investment opportunity set, and these investments come under the alternatives umbrella. They're vast and varied in characteristics and are typically actively managed skill-based strategies which may navigate general market headwinds. What's more, some of those strategies and vehicles like long-short investing or venture capital, for example, don't rely on equity markets to go higher in order to be successful. They can often zig when the market zags.
So investors should be looking to a wider opportunities of investments, alternative investments, private markets to enhance returns, diversify risk. How can private equity help balance portfolio risks in the current environment?
Sure, David. So private equity is a long-term return enhancement strategy that includes things like buyouts and venture capital, but can also include growth equity, secondaries, and distressed, each of which have different risk-return profiles, return dynamics, and liquidity constraints, which should be considered. Historically, private equity has provided between 1% and 5% excess return over public equity, like stocks, according to JP Morgan. There's typically several reasons for this, though. So firstly, is that long investment horizon. So typically 7+ years for an investment and 10+ years for the life of a fund. That really gives the fund's general partner or their GP ample time to create and realize value from the underlying investments. And since these are typically long lockup, there's less liquidity associated with them. Investors may be compensated in the form of an illiquidity premium. And finally, companies within the private market or private equity landscape, such as venture capital and growth equity, actually provide access to newer, potentially high growth companies who are early in the establishment phase of their businesses, as opposed to public companies that are typically more mature by the time they come to market.
Does the floating rate structure typically associated with private debt provide an alternative opportunity given the outlook for higher rates?
So, David, the short answer is yes. And then while not all private debt is floating rate, it generally is. And that feature not only allows the yield on private debt to move higher as broader interest rates increase and benchmark interest rates reset, it also lowers the duration or interest rate sensitivity of those types of investment. And that's an additional benefit to investors over and above the generally higher interest rates available on relative to public debt, since private debt seeks to provide, again, illiquidity premium to compensate investors for its less liquid nature. And we see significant demand for private debt in the current market environment, especially things like direct lending.
What makes other alternative investments, like maybe hedge funds for investors, looking for opportunities maybe to dampen volatility, offset broader market risks?
Yeah, it's a great question, David. So hedge funds themselves are probably the most heterogeneous industry within the world of alternative investments. That offers investors a wide range of strategies that offer unique exposures to different types of risk, as well as different sources of return that typically don't rely on the directionality of the overall markets. Additionally, as we head into monetary policy normalization, there's hedge fund strategies that use macroeconomic drivers to generate returns, while others may use idiosyncratic events like mergers and acquisitions and distress in special situations to generate non-correlated returns. So there's the opportunity to allocate to market neutral strategies or long-short strategies that seek absolute returns, irrespective of whether the broader markets are moving higher or not. So given these exposures to non-traditional return drivers, hedge funds may play an important role in achieving a well-diversified portfolio going forward.
Thanks very much, Nick. Certainly a lot of opportunities to broaden away from the 60-40 portfolio. A lot of opportunities now in alternative investments. Platforms like CAIS make that a lot easier. Thanks very much for joining us.
Thanks, David. Thanks for having me.